Lecture 2. Income Statement. This lecture provides a basic understanding of the income statement. Upon successful completion of this lecture, you will be able to describe the purpose of an income statement, define the basic components of an income statement, recognize and understand the meaning of several items typically presented on an income statement. The income statement is a financial statement that reports a company's financial performance over a specific accounting period. It is the first financial statement prepared. Financial performance is assessed by giving a summary of how the business incurs its revenues and expenses, through both operating and non-operating activities. So the income statement reports a business performance for the period. It also shows the net profit or loss incurred over a specific accounting period. The income statement calculates net income or loss over a range of time. A simple format for an income statement is, revenues minus expenses equals net income. For example, annual statements use revenues and expenses over a 12-month period, while quarterly statements focus on revenues and expenses incurred during a 3-month period. Revenue is the amount of money that a company actually receives during a specific period. Revenues are earned for the sale of goods or services. Note that revenues occur when the sale is made. The payment may or may not have been received. Revenue is known as the top line because it is displayed first on a company's income statement. Examples of revenues include sales, service revenue, and interest revenue. Expenses are money spent or cost incurred in an organization's efforts to generate revenue, representing the cost of doing business. Expenses are incurred when a business receives goods and services. Like revenues, payment may or may not have been made. Examples of expenses include salaries expense, utility expense, and interest expense. Most businesses require more information from their businesses than a simple income statement can provide. Therefore, they use a multi-step income statement format. The multiple-step profit and loss statement segregates the operating revenues and operating expenses from the non-operating revenues, non-operating expenses, gains, and losses. The multiple-step income statement also shows the gross profit, net sales minus the cost of goods sold. The cost of goods sold is reported on the income statement, and can be considered as an expense of the accounting period. The cost of goods sold is the cost of the product that a retailer, distributor, or manufacturer has sold. It represents the expenses a business incurred to buy or make that product. By matching the cost of the goods sold with the revenues from the goods sold, the matching principle of accounting is achieved. Operating expenses are the expenses incurred in carrying out an organization's day-to-day activities, but not directly associated with production and which are reported on its income statement. These costs are reported as operating expenses on the income statement, because they pertain to operating the main business during that accounting period. These costs may have expired, may have been used up, or may not have a future value that can be measured. Operating expenses include such things as payroll, sales commissions, employee benefits and pension contributions, transportation and travel, amortization and depreciation, rent, repairs, and taxes. These expenses are usually subdivided into selling expenses and administrative and general expenses, also called non-manufacturing expenses. Operating income or losses are separated from non-operating income and losses, to avoid confusion between the activities of the business and extraordinary or incidental events. In some cases, non-operating items are referred to as income from secondary activities, while the business's normal operations are considered primary activities. Non-operating items on an income statement includes anything that does not relate to the business's main profit-seeking operations, such as interest, dividends, and capital gains or losses. The income tax reported on the income statement is the income tax expense, which pertains to the revenues and expenses shown on the income statement. The income taxes to be paid in the near future are reported as a current liability. There are also balance sheet accounts for deferred income taxes. End of Lecture 2. Thank you.